Welcome back to Indianomics. We've been discussing the growth trajectory of the Indian economy with Dr. Arvind Virmani, Dr. Subir Gokarn and Sonal Varma. But where is the economy poised as far as the Reserve Bank's policy is concerned? First, let me play to you what an exclusive CNBC TV 18 poll indicated.
The fall in food inflation and the steeper fall in crude has raised the decibel levels of those wanting a rate cut. However, majority of bankers and economists polled by CNBC TV 18 say Governor Rajan will yet again keep policy rates unchanged on December 2nd. Only 5% expect a 25 basis points rate cut this time. With consumer price inflation falling to 5.5% in October and crude falling to a 4-year low, most respondents agreed that RBI could start cutting rates earlier than previously expected. While 50% expect the first rate cut in February, the remaining 50% don't expect a cut this financial year. Yet almost everyone acknowledged that RBI will not be able to hold on to the rates for too long. 90% of bankers and economists polled say RBI will have to cut policy rates by as much as 100 basis points in the next calendar year. On growth, 65% of the respondents expect GDP growth to come in as expected at 5 to 5.5%. Only 35% expect growth above 5.5%. On inflation, however, the expectations have tempered. 60% of the market expect March and consumer price inflation to come below 6.5%. A few optimists even expect inflation to fall below 6% by March 2015. Until just 2 months back, RBI and many researchers had projected March and inflation at 8%. So will this policy be a non-event? Not really. Firstly, quite a few market participants expect RBI to cut SLR or statutory liquidity ratio this time. Some even expect Governor Rajan to announce a possible relaxation for restructured accounts of banks. But more than all these, bond markets will be closely watching the governor's tone and guidance. 60% expect his tone to be dovish, while 35% expect him to retain a neutral tone. In short, words will yet again be more important than action. In Mumbai, Gopika Gopakumar.
All right. Not too much of an expectation for a rate cut from bond market economists and banker participants who we polled. But Dr. Virmani, how crucial is a rate cut to your growth expectations? Aren't most of the projects timid for reasons other than interest rates?
Well, as you know, I really cannot comment on monetary policy till December 3rd. So let me say a little bit about inflation. For the last 2 months or so, I have been saying, both inside, outside, that the inflation is now on a clear downtrend. That's one point. And of course, this was well before the big oil declines and the 5.5 number. And basically, one of the factors was the sharp decline in WPI. And my analysis, which showed that the gap between CPI and WPI generally closes. But the second point I would make is that if you look at the GDP deflator, and I was the one who introduced this consumption deflator to use as a measure at that time, because we didn't have a good measure,
Dr. Virmani,
and that is showing 4.5%.
Dr. Virmani, will there be too much leeway for interest rates to fall simply because if growth picks up, then that will use up the excess capacity, isn't it? And if the intention of the monetary authority is to take us towards 6 and then 4%, is there so much leeway? How much can rates fall, say, over a 12-month period?
Well, again, I have to answer generally. If you look at the real repo rate, it is about 2 months ago, it was plus 2%, 8 minus 10. It was negative 2%. Now it's up to positive. You take current, even the last number, 5.5. It's 2.5% positive. So this trend, in my view, is going to continue. Not exactly at that same pace. So that issue is there.
Fair enough. Dr. Gokarn, you have seen much of this period. We have belabored under double-digit inflation for food inflation for a longish bit. Are really all the risks out? I mean, can a stray onion inflation or, a vegetable inflation still really yank up inflation expectations, and the RBI's inflation expectation numbers are not really softening? So has the battle against inflation been really won, the crude price fall notwithstanding?
Well, I think there are two aspects that your question raises. One is, what is actually shaping inflation expectations and why have they been so stubborn in not responding to what are clearly softening trends on many fronts, including petroleum products, which I think have a very important bearing on inflation expectations, and particularly in a situation where food prices, which were expected to surge after an indifferent monsoon, have actually been relatively comfortable, have softened. We've seen a negative, a price decline in vegetables, which is something we haven't, seen for a long time. So I think we have to get a little closer to an explanation as to what is driving inflation expectations in this economy. I think we really are in a situation where if you take expectations as the basis for policy, and it's obviously that's the framework, that's the theory, then we're in a situation where unless we continue with an extremely tight monetary stance, we're not going to get expectations down. But if you take the headline numbers and both CPI and WPI, then you're saying, well, the business cycle is playing itself out. The supply shocks that we've had with oil and food have been positive. So there is room to cut. So I think there is an analytical issue that we've got to resolve. But let me just talk about the food inflation risk particularly. We've seen some relatively positive actions, particularly in terms of how the government has sold down from its cereal stocks, rice and wheat, and that has had a dramatic impact on rice prices. Before the middle of 2014, we had 2 years of 16-17% rice price increases. After the sales began, we've seen it come down to between 6 and 7%. This is actually offset all of the monsoon impact on other prices, and considering that the monsoon actually recovered in the second half, that I think has had a positive effect on vegetable prices. So there are some sort of long-lived factors, there are some temporary factors. I don't think we've dealt with food inflation structurally. I think the risks are still very much there, but we've seen some actions that have helped it come down. I think we will see some benefits from this for some time.
Therefore, can monetary authorities be terribly bold about rate cuts for the next 12 months? How early should they start cutting, and how much may they be able to cut?
I really don't make predictions about monetary policy, nor do I give advice in public, so I'm going to pass on that question.
Definitely to the person who will perhaps be a better place to speak about it. Sonal, what is your sense? How quickly can the governor cut, and how much leeway will he have to cut over the next 12 months?
I think the point that expectations are still high is relevant, and we know that expectations in India are adaptive. Now things are falling in place both in terms of some sort of a demand compression because of the tight macro policies, and also because of the impact these have had on supply side, in the sense that cost pressures, particularly wages, are growing at a slow pace. So I think conditions are now there for actually inflation to undershoot even the 6% target in the next 12 months. So what we need to see, therefore, is for all of this to play out in terms of lower inflation, lower food inflation, and gradually inflation expectations coming down. In this scenario, I don't think RBI should be ahead of the curve in terms of trying to cut rates. Our prediction is that there is going to be some space, but probably to the extent of maybe about 50 basis point or so. So we are penciling in a 25 basis point cut actually in the second and the third quarter of calendar year 2015. But I think, unlike the past, many cycles in India, I think policy stance in India is likely to be either neutral or tight, because if the RBI is moving towards a flexible inflation targeting framework where we are targeting inflation to remain, in the 4 to 6% range, even as the growth cycle starts to pick up, then actually there is no scope for monetary policy stance to become accommodative, in this regime.
At the most, 50 basis point cut all of 2015, starting perhaps April.
Yeah, our base case is for June. There is obviously some probability to April, but we're penciling broadly in the second and the third quarter.
All right. We will have to wrap up this discussion because we are out of time. But the vibes from the experts are it's very positive on growth. On rates, perhaps they are divided with most of them not expecting a very early rate cut, but some scope in 2015. Thanks for watching this edition of Indianomics.